Let's review the income statement in a similar fashion to the way that we review the balance sheet. The purpose of the income statement is to record and present the revenues and expenses for the firm for a particular period. In this way, the income statement gives us a much better picture of the flow of funds or the flows of funds through our firm. So as we did with the balance sheet, we're going to look at a simple income statement on the next slide. Here we have a simple income statement. And we notice, first of all, that the income statement is for a period. So this income statement is for some year, 2000 and some year. And we see that the income statement begins with sales, and then we deduct our operating expenses of cost of goods sold, selling general and administrative expenses, and depreciation expense. We have a subtotal that follows of earnings before interest and taxes. Then we subtract interest, and we're left with earnings before taxes or taxable income. Earnings before taxes is taxed, and we compute the taxes that were owed, and then we have net income that remains. This is where a traditional income statement might end. However, we've tacked on two additional items of dividends paid and additions to retained earnings. So we're going to talk about each one of these items in order as they appear on the income statement. The first item, which is not listed on this screen but is important for us to talk about, is sales. Sales, sometimes referred to as revenues, reflects the gross income that we have before we adjust for any expenses that we incur. So whatever we do as a business, sales is going to reflect the revenues that we've brought in on a gross form. And then we have cost of goods sold. That's the cost of sales. We also have selling, general, and administrative expenses. Those are the expenses that we incur not directly related to making the product, but definitely directly related to selling the product. So cost of goods sold would be materials and labor. Selling, general, administrative would be customer service or our marketing crew that goes out and sells our product and makes sure that it's placed properly in stores. Then we have depreciation. We know that depreciation, again, is one of those accounting decisions that we have to make. What form of depreciation are we going to use? And so that's the depreciation expense for a given year is what appears on the income statement. Then we have earnings before interest and taxes, sometimes called operating income. Then we have interest expense. Interest expense is directly related to the debt that we have on the balance sheet. So however much debt we have, that's going to be tied in some way to the interest expense that we paid. We talked about in the balance sheet portion of the presentation how we're going to assume that our long-term debt is interest only, meaning that we borrow the money today, we pay the money back at the end of some period of time. In between now and then, we're only making interest payments. This is the interest payment that we're making, is our interest expense. That's where that is reflected. Then we have EBT, earnings before taxes, also called taxable income. And then we compute our corporate taxes. Once we subtract corporate taxes from taxable income, we get our net income or our net profit. And again, that's where a traditional income statement would stop. However, in this class, we're going to tack on two more items. And these two items would appear on a statement of retained earnings. We're not going to do a separate statement of retained earnings. What we're interested in from the statement of retained earnings is, first of all, what is the dividend that was paid in total to our stockholders? That's DIV. Then, once we take net income, we can only do two things with net income. We can either pay it out as dividends, DIV, or we can keep it as additions to retained earnings, which we'll call RE. So as we work down our example income statement, we get all the way down to profit, and then the last two lines show us where that profit goes. Does it get paid back to our stockholders in terms of dividends, or does the firm keep it and plow it back into the business? Keep in mind that our accumulation, our additions to retained earnings are added back into the accumulated retained earnings. So if we make $1 of profit and half of that dollar goes to additions to retained earnings, well then now we're adding 50 cents into our accumulated retained earnings pool, which means that our liabilities and equity side just grew by 50 cents. According to the balance sheet identity, if the liabilities and equity side grows by 50 cents, the asset side then has to grow by 50 cents. So, in other words, when we retain earnings, we're actually allowing ourselves to purchase more assets without having to go and borrow money from a bank, from our creditors, or from taking on new shares of stock. The other point that I want to make here in terms of the income statement is that we have one major item in depreciation that is very special relative to the others. When we sell an item, we receive cash for it. When we pay our suppliers for cost of goods sold, or when we pay our labor for cost of goods sold, when we pay our supporting personnel for selling, general, administrative, when we pay interest expense, when we pay taxes, we're paying cash for those. The thing that you want to remember is about depreciation is that it is a non-cash expense. And therefore, when we start working with our cash flows, we're going to have to make an adjustment for depreciation, because even though we count depreciation as an expense, we never actually write a check for it. So it is a non-cash expenditure. So I want to point out some income statement relationships. First of all, cost of goods sold. Cost of goods sold tells me, what was the cost of making the products that we sold. Well, that relates to our inventory policy that was on the balance sheet. You may remember in accounting, with respect to inventory policy, we have choices of how we account for the cost of our inventory. Included in these are LIFO, or last in, first out, FIFO, first in, first out, and the average cost method. And what we know is that depending on which method we choose, that impacts the level of inventory that we see on the balance sheet. If we assume, for example, that costs rise over time, then a last in, first out would mean that we sold the most expensive items that we made this year, and we retained the cheapest items that we made this year. So that would, using a LIFO method, would minimize our inventory cost. But minimizing our inventory cost maximizes our cost of goods sold. So there's two sides to that coin. FIFO would be exactly the opposite. First in, first out, if costs rise over time. First in, first out says that we sold our cheapest items, and kept our most expensive. So our inventory level on the balance sheet would be high. However, our cost of goods sold would be low because we sold the cheapest ones. So there has to be a relationship between what we do for inventory on the balance sheet and how we reflect that in our cost of goods sold in order to be consistent. The second thing that I want to point out is that, again, depreciation is related to property, plant, and equipment or fixed assets from the balance sheet. And we have a choice of depreciation methods. And although we'll probably use only one or two as you go through your undergraduate program here, there are a number that could be used under generally accepted accounting principles. So the choice of depreciation method affects our depreciation expense that we'll see on the income statement, and then that will be linked to the balance sheet. The third thing is that interest expense is, as we mentioned, directly related to the debt that we have on the balance sheet. And finally, as we also mentioned, the additions to retained earnings that fall at the bottom of our example income statement, that's related to stockholders' equity from the balance sheet, because once we retain those earnings at the bottom of the income statement, then we deposit them into the account, so to speak, on the balance sheet, and that allows us to purchase more assets because we have to make our balance sheet balance. Now, the retained earnings additions results from net income. It comes from profit, but it also comes from our dividend policy. Whatever we do, whatever profits we make, we can either pay them out as dividends, and then we keep what's left over as retained earnings. So if our board of directors instructs us to pay a large dividend, then that's going to be less money left over to retain. If, on the other hand, our board of directors says, don't pay a dividend, retain all of your profits, then that allows us to finance using our retained earnings as our number one source of funds.